Any 1 month, I would say 1 month is no months because they're up, they're down, they're up, they're down. The market's yelling at the Fed, oh, you idiots. It was higher than you thought. It was lower than you thought. You got to take an average. If you take the average, 227 is a big number, bigger than what we would think would be, let's call it the break even. Last month was a very small number, 12,000, well below break even. Before that, it was better than expected. The month before that, it was worse than expected. On average, it basically feels like both the payroll number and the unemployment rate and the various ways you look at the job market, it was cooling for a while from the hottest that we've ever seen to something like sustainable full employment, let's call it. And what we wanted to do is stabilize there and not keep getting worse. And the last several months feel like it's hovered around in that space. We've had hurricanes and strikes and things that make it hard to figure. But if you take these 2 months together, 12,000 and 227,000, you're in the 120 to 140,000 a month kind of range. And that's, to me, that feels like in that is sustainable full employment kind of space.
Yeah, October was obviously noisy with the Boeing strike
Yes.
and the hurricanes, but it seems like with this rebound, October was a speed bump and not the beginning of the cliff.
Exactly. And now a condition can change. They change all the time. But if you take this long arc, that feels like a steady as she goes. And I will say in our business contacts, as we talk to members of our board and we talk to people in this room, and Tom gives us the contact calls, they very much summarize in this space of it's steady, it's not getting worse, it's not dramatically getting better, we're chugging along. Everything's always on the table. And the hardest thing that a central bank has to do is get the timing right, moments of transition. And this is where we are. We're in a moment of transition. So we're going to have a series of meetings that are close calls between cutting and not cutting, between 25s and 50s and stuff like that. And we're going to get yelled at, you did it wrong. No, you did it right. And we'll come back in 6 weeks and, we'll keep adjusting. But if you take the long view and say, forget about just what the next meeting or the meeting after that, ask over the next year and over the last year, how's it going? Where are we headed? The inflation rate is almost to where we want it to stop. The unemployment rate is around where we think it's going to settle. The economic growth is around the trend where we think is sustainable. And the one outlier is that the interest rate that we set is well above where the consensus in the dot plot says it's going to settle down. And so my thing is, if the bathtub is too hot, you add cold water. But once you get to where you want it, stop adding cold water or you know what's going to happen. And so I think over the next year, if conditions evolve the way they have been and the way that I expect them to, rates are going to be a fair bit lower than where they are today. If you join us again next year, that'd be my expectation.